All right, welcome to your Market Fluency Daily Brief. It's Thursday, February 19th, 2026.
So that 3-day winning streak we were all enjoying, yeah, it hit a brick wall today. The big theme was what we're calling geopolitical jitters. Basically, Wall Street got a little spooked and decided to cash in some chips.
Okay, let's look at the numbers. The S&P 500 slipped just under 0.33%, and it was really a 1-2 punch that did it. First, we got some pretty hawkish minutes from the Federal Reserve, reminding everyone that rate hikes could still happen if inflation acts up. And then, bam, oil prices spiked over 2.5%, all on reports of some potential tensions between the U.S. and Iran. And the Dow felt it even harder, dropping over 0.5%. Look, it was a classic risk-off day, for sure. But the real story, the interesting stuff, was happening underneath the surface with individual companies. That's where things got really telling. So let's kick things off with our first deep dive, Walmart. They're the ultimate bellwether for the economy, right? And what they told us today, well, it was a major reality check about the state of the American consumer. So here's the move, and this one's kind of wild. Walmart's stock actually opened up in the green, but then it just took a nosedive, completely reversing course and ending the day down almost 1.5%. So you're probably asking, what on earth happened? What was the driver here? Funny enough, it had nothing to do with how they did last quarter. That was actually pretty strong, a solid holiday season. Nope. The entire sell-off was because of their forecast for the next year, which came in a lot weaker than anyone expected. So it was all about the forecast then. That's what tanked it? That's it, exactly. You got to remember, the market is always looking ahead. It doesn't care so much about what you did yesterday. It cares about what you're gonna do tomorrow. And this is the crucial takeaway. When the biggest, most defensive discount retailer on the planet braces for a slowdown, it's a huge warning sign. It's like the canary in the coal mine for the whole economy, suggesting the consumer might finally be tapping out. Okay, now let's do a complete 180 from Walmart's cautionary tale. We're talking about Deere Company. And let me tell you, this report shows that the physical economy is just roaring. Wow, the move here was just incredible. Deere stock didn't just go up, it skyrocketed, over 13%, and the volume was absolutely massive. This wasn't just a good report, it was a huge statement to the market. And the driver is just pure, old-fashioned, fundamental strength. Deere didn't just meet expectations, they absolutely crushed them. Management was pointing to this huge surge in demand from both their construction clients and smaller farmers. It's just powerful proof that while everyone's talking about tech and AI, there is immense profit in demand in the companies that actually build and feed the real world. All right, for our last deep dive, we've got Carvana. And this one is a really fascinating lesson in what I like to call the margin trap. It just goes to prove that in this market, right now, you have to be perfect. So the move was, well, it was brutal. The stock just plunged, down over 9%, one of the worst drops of the day. But why it dropped, now that's where the real lesson is.
Wait, hold on. Didn't they beat on overall profit? I don't get it. What happened?
That's the million-dollar question, right? And the answer is one layer deeper than the headlines. So investors basically ignored the fact that they made a profit overall. Instead, they zoomed in on one tiny detail, the profit they made per car sold. And because that number was just a little light, bam, the stock got crushed. It just shows you, in this kind of nervous market, top-line success isn't enough. Wall Street is picking apart every single detail.
Okay, let's bring it home with the water cooler. This is where we give you the exact talking points you need to sound like you've got this all figured out tomorrow morning. All right, first step on Walmart. Here's what you're going to say. Walmart's earnings call was a bit of a reality check. Their profit forecast was weak. When the ultimate discount retailer starts lowering expectations, it usually means the middle-class consumer is finally starting to tap out. Next, on that huge jump from Deere, try this. It's funny watching the market obsess over tech and AI, and then Deere comes out of nowhere and jumps 13%. It turns out, we still need giant tractors to build houses and grow food. It was a great day for the physical economy. And finally, to explain what happened with Carvana, here's your line. Carvana is the perfect example of how picky this market has gotten. Because their profit margin per car dropped a little bit, the stock tanked 9%. Wall Street doesn't just want you to win right now. They demand that you win perfectly. So that leaves us with one big question for you. Deere jumped 13% today while the rest of the market struggled.
Are you starting to rotate your portfolio out of tech and into physical economy stocks that actually build the real world? Drop your strategy in the comments.
Comment below. Subscribe to Market Fluency for your daily edge.